One of the most common questions we get at Business Development Center is, what structure of business should I register? There are basically three types. There is a sole proprietorship, a partnership, and a corporation. And one of the things I want to share with you right from the beginning is that corporation sounds to many people like a big company or an expensive proposition, and they disregard it when they're first setting up a business. I do want to remind you that there are many advantages of having a corporation, and as we go through the video, I will share those with you. It's not for everyone, but if you're armed and knowledgeable about the advantages and disadvantages, you'll make a better decision. Certainly, if you already know what structure you need, you've chosen a name and you're ready to get on to our online system or to call in, we will go ahead and process your new business, and you'll have your business registered within a matter of business days. But let's talk about the differences for those of you that would like to hear that. A sole proprietorship is the simplest form of business and the least costly to set up. It's one person, and when you register a business name, you will now have a master business license. If you're opening bank accounts, for example, it helps a lot to have a registered business name. You could be running all of your activities and financial matters through your own personal checking account or through your own tax return at the end of the year. With a sole proprietorship, you do still have the ability to put it all through your personal tax return, but if you've registered a business name, you have that advantage. Again, as I mentioned, it is a distinct name. You can open a bank account under that name. It gives you credibility. Now, with a sole proprietorship, there are some disadvantages. Because you and the business are really one, if, let's say, something goes wrong in the business or there's a reason that someone wants to take an action against you, a legal action, they will unfortunately be able to come after you personally because you and the business are one. So, should it come to the question of your being sued, they will have access to your personal assets, your car, your home, and so on. We're sure you won't run into that kind of trouble, but things do happen, and it is not uncommon. If you're a sole proprietorship, you are vulnerable. If you're a corporation, which I'll explain in a minute, you are not as vulnerable. Now, a sole proprietorship and a partnership are very similar. A partnership, of course, means that there are several partners, and you should have a partnership agreement. But again, it's very simple. It means that each of you will be running your revenues and your expenses through your personal tax returns on whatever basis you share. But there is no requirement for a corporation in that case. There is certainly the requirement to register the partnership, but the financials will all go through your personal financial tax returns. With a partnership, other than the partnership agreement, it is not very complex. The advantages, again, of sole proprietorship and partnership: inexpensive, no reporting requirements other than through your own personal tax return. But let's turn to corporation for a minute, because its advantages are basically the disadvantages of the other two. So the big reasons that people incorporate are the following. First, there is the ability to split income. So let's picture what a corporation looks like. Corporation is not you. You own the corporation, or many people own it, but let's assume it's one person. You own the corporation, and it is its own distinct entity. Your revenues, your expenses are being charged and earned by the corporation. If, and as we hope is the case, you have a profit, the corporation has made a profit. So far, you haven't received anything personally. You will pay yourself from those profits, but what happens is any profits that stay in the corporation, they are taxed at a very low rate. And it can sit there and grow, and again at that low rate until you take it out. The tax splitting I talk about is you can be using those profits and paying yourself or family members that are active in the business other employees, of course, but as owners, you can split the revenue or the profits. And if you split those profits, let's say among two people, it means that each of your tax levels will be lower. So let's just say, for example, that there's $100,000 of profit being paid out. Well, if you take that $100,000, you'll be charged at the tax rate. You'll be taxed at the rate of $100,000. If you split it and it's $50,000 each to you and a family member who is involved in the business, you will both be charged at a lower rate of tax. Big advantage. With all of these things, you should speak to an accountant or speak to us to get our advice. Beyond income splitting, the next most important would probably be the idea of liability. So I mentioned earlier that as a sole proprietor or partnership, if things go wrong, if there is an action against you, they will come after you personally. With the corporation, it will be the corporation's assets that someone can come after, not any of your personal assets. Now, there are some minor issues here which you would need to investigate. Generally, what I've said is correct, that the entity of the corporation is what would be sued. You can't be negligent personally, because then there will be some personal responsibility. Well, there are still more advantages of corporation that we'd like to talk about. There are two particular areas that are of interest to most entrepreneurs. One is the issue of borrowing money or raising capital, and they're very different. While this isn't a seminar on financing, basically the two common forms are to borrow money or have a line of credit, that type of thing, from a bank or other individual or institution. When you're a corporation and you're filing annual financial statements, income statement, balance sheet, and so on, there is that rigor that people appreciate when they're lending to you. They want to know that everything is being managed and looked at professionally. You can borrow if you're a sole proprietor or a partner. However, serious borrowing, or more commonly the kind of borrowing that happens from a bank, is with a corporation. So for those reasons, we ask you to consider the idea of incorporation. Raising capital is different. So if you want investors in your business, or you plan to grow by raising other forms of capital, then a corporation is almost mandatory. I say mandatory because, again, you do not have to be a corporation technically to have someone invest in you, but it will make all investors far more comfortable if you are a corporation. And I would guess that 98% of capital and investing happens into corporations. It's simply much simpler. Again, it's that entity, a separate entity. Someone is investing in it and they will have a share of that entity. When it's a corporation, it's far cleaner and far more comforting to the people investing. While we're talking about financing, there's the ultimate end of a corporation, which would be the sale. You can sell a partnership. In fact, you can sell the assets of a partnership. You can also sell the assets of a sole proprietorship. I'm saying the assets because technically you cannot sell a sole proprietorship or the business license because it's to one person. Remember, when we talked about sole proprietorship, it's you and it's connected to your personal financial returns at the end of the year. If what happens is you go to sell your business, then a new master business license would have to be arranged. That's very doable, but it's a little bit complicated. When you sell a corporation, it's that entity again that can be sold. Now, selling a corporation is really not that much simpler than selling a sole proprietorship or a partnership. But it is very commonly accepted that, for example, the term perpetual succession, people think of as a corporation. It has a life on its own. It gets bought and sold and it grows over time. Typically, sole proprietorship or a partnership does not experience that. And again, if it does, a new business license is required. What else is an advantage of a corporation? A smaller one, perhaps, is the fact that once you've registered a corporation, let's say there are different types of business activities that you will have as you grow. Each of those business activities can be given its own trade name. What that means is it could be your business is incorporated, but you would be operating as, and that's the common term, is operating as whatever other business name you want to register underneath the corporation. Financially, it all flows through the corporation, but from a marketing perspective and hiring and business cards and even internal financial management, each of those trade names can be separate within the corporation. While we're on the discussion of corporations, there is such a thing as a shelf corporation. It basically means that we have corporations that are set up, have been in existence for time, and sitting on the shelf. We've just discussed about you registering your business or incorporating, and you can, of course, do that. With a shelf corporation, what can often happen is it can be a business that is in existence for a period of time. The corporation itself was set up some time ago, and you can buy that corporation and bring with you that years of clean credit history. If it's important that you be perceived to have been in business for a long time, a shelf corporation can accomplish that. And there are other advantages of setup. Look into a shelf corporation if you feel, first of all, that it's important, A, that you have some history behind your corporation, or B, there can be some advantages in speed of setting up your corporation.